Never, ever, ever stop buying. The market is just as much a mental test as it is, are you putting your money in good companies, good ETFs, things like that. Of course, this is my personal opinion, but we're going to be diving in this video today why I think you should never, ever, ever stop buying. Now, of course, not every situation is perfect. If your personal finance side of things is bad, you have credit card debt, obviously should not be investing. I don't cover personal finance on this channel, however, I believe in it wholeheartedly. You should do plenty of research on that as well. Another situation, if you lose your job, things like that, life happens, you can't always buy, and I understand that. That also ties into personal finance. The last one is a bit unique. It's if you can't live off of dividends in retirement. If you're nearing even 10 years to retirement age, 5 years certainly, but even 15 years out, you should be a little bit more cautious and be aware. But if you have plenty of money to live off dividends and you can just keep reinvesting, things like that, there's some of you watching this video that can do that, and there's plenty of you that think that concept is almost absurd. But it's important to get those caveats out of the way. But assuming you're not just near retirement, you have 15, 20, 25 years out, your personal finance side of things is good, you and your spouse have a job, you should never stop buying, in my opinion. And my main point for why you shouldn't stop buying is when you look at market returns. The S&P 500 since 1993 is up 1,300%. And you can do an easy counter and say, well, what about all the times that it wasn't up that high? Well, let's take a look at that. I would agree with you. It's not always just going straight up. From 1995 to early 2000, the dot-com bubble, the SPY was 3.1x, 3.3x, somewhere in that range. Clearly, it ran up very high. Also, the S&P 500 PE was incredibly high at 45, but we can see that it wasn't till in 2013-ish that you would have gotten that high and stayed that high. Now, there was times where you peaked in 2007 where you would have basically been up. But if you just continued to DCA in during all the other time periods, you would have your money here in 2003 that you bought in almost during that entire year would have been up significantly in 2007. And the lows in 2009, if you kept buying in, you would have been up a lot really quickly. So all the money you put in, not at the very tippity top, would have been generating a lot of money. That money you bought in lower would have been worth more. And assuming this is retirement investing, not money you need right away, you would have done incredibly well. If you have your personal finance side of things taken care of, which I understand that's not always possible, but if you do and you're DCAing in lower, this money that you're buying in lower is actually really good. That's going to do better than buying in high and just running flat, because it's going to run back up, and it did in all these scenarios. Now, another point is, when it's crazy high, like I said, the S&P 500 PE at this time was 45. Right now, people think we're kind of high, and I think we're kind of high, and we're at 30. So we could run up 50%, we'd still only be as expensive as here, and this was, right, you would have still been up 13 years later, but aside from that fact, but you don't have to buy. Wait, you just said you should always buy, but then now you're saying you don't have to buy. Well, I still think you should buy, but that doesn't mean you have to buy the S&P 500. Now, this is the same website we're using. We're just comparing the S&P 500 to Pepsi. And one thing you will notice is when the S&P 500 was hitting record highs in 2000, the dot-com bubble, one thing Pepsi was not doing is that. It actually didn't, it was hitting highs, in 2002, when, the S&P 500 was going from 3.2x to 2.2x. And we were still hitting all-time highs here. And even then, if you bought, in 2000, late 1999, you're about 1.9x, 1.7x. Even in these lows that the SPY was hitting, S&P 500 is hitting, you're still higher, 1.8x, or roughly flat. That's not bad. That's really not bad. So even if the S&P 500 is at 45p, you say that, okay, that's too expensive for me. That's fine. The point is, even when the market is expensive, that doesn't mean every stock is. Certainly in today's market, where you can find stocks that pay 3 to 4 to 5% dividends, you're going to be able to reap that even if the share price is down. And these are in stable industries, something like the utility industry. So you think of something like Dukes or American Electric Power. These companies are going to give you 3.5 to 4% dividend yield. You don't really have, or a bubble that pops, right? You don't really have to worry about that. And it's really, the main point is just what it's compared to. Because if you look long term, what the dollar would do compared to what the S&P 500, even with the downturns. It's not even really close. You lose money year after year after year on cash. Now let's just say, okay, maybe I don't want to buy stocks. I want to hold real estate, or I want to do this or that. That's fine. Or like in your own business, invest in that. That too. If you're getting returns comparable to the market in some other thing like real estate, which is, there's also crashes in real estate. Look at this here. So you're not without risk there either. But real estate you'll do fine in. I'm just saying, you should buy. Put your money, allocate your money, invest your money in, if investing in real estate is investing. It's not what I specialize in, but it's certainly investing in your own business. But like I said, during a recession, I don't know how good that business is going to do. But that's, if you think that's where it's best used, you just should never be having insane, in my opinion, of course, do whatever you want, insane amounts of cash just sitting there. It depends on obviously how much your net worth is and whatever it may be, but you should always keep buying, keep putting your money to work. That is so important, because if you look at how much inflation just wrecks the dollar, even with the downturns, you're going to absolutely, even from here to here, right? Even from 95 to the lowest low, you're still 1.4. You're still, inflation's going to take 3% off your dollar year after year. Anyways, I think I've covered most of what I want to in this video. If you guys enjoyed, I'd appreciate it if you like or subscribe. I do daily stock content on this channel. If you disagree with me, I'd also like to hear your reasoning to why. But anyways, I appreciate all of you for watching, and I'll catch you next time.